S&P, very bearish on the ratings of credit in the United States last year. We know the story in the price action, very, very different.
Yeah, so I mean, they've really given companies the benefit of the doubt over the past 5 years. So, I mean, there has been a slowdown in cash flow growth. You've seen that manifest itself in earnings, right, if you're an equity player. And so this is just somewhat of a topping off. So I don't view this as a really horrible trend per se. It's a little slow to react, as quite frankly, the years prior, there's been so much leverage put onto these balance sheets that they quite possibly didn't deserve those ratings in the first place.
Andy, let's bring you into this conversation. When you hear things like the most downgrades relative to upgrades since 2009, people worry when they hear the number 2009. Should they be concerned about the credit ratings of some of these companies relative to where they're priced currently?
I think the pricing is the issue as opposed to the fundamentals themselves. Pricing and fundamentals the pricing has got way ahead of the fundamentals because of the QE, because of the search for yield we talked about in the previous segment. I think what we'll see in 2020 is much more dispersion amongst credits, particularly in investment grade. You saw it, I think, in high yield last year, where the triple Cs didn't do so well, and very few bonds yield the index, so to speak. But I think you'll see companies that are on top of their deleveraging plans, following it through, will be rewarded, and those that don't show discipline will be punished, because there's no question that prices are very expensive of credit. You do not get the kind of excess returns that we had last year across pretty much every sector. And you're not able to get that again this year without something materially changing. So I think people should be cautious in credit just because of the entry point they've got at the moment.
You agree with that, Greg?
No, not really. You should always be cautious in credit, right? Because it's a scary place, because there's nothing but downside and the upside's very limited. And that's very much the case in 2020. But I still think it's a pretty decent environment for credit. So pricing has definitely come a long way in a short period of time. A lot of that, though, was just a reversal of the prior year. But I think, unless you see a real uptick in defaults and companies continuing to trash your balance sheet. So while there's been more downgrades, you haven't seen companies actually look to impair their balance sheet. And what I think that's really important. So I think it's too early to sell the credit rally. And I think there's way too much negativity around triple Bs, and I think there's way too much negativity around high yield bonds in particular.
Well, let's talk about triple Bs and high yield bonds. Triple Bs had their year in 2019. Regardless of all the concerns coming into the year, they had a fantastic year of performance. Triple Cs did not until December of 2019.
Yes.
Are you on that bandwagon now for 2020?
Yeah. So I think we were on a show back in November, and you asked me the question, and I thought it was time to dip in. It was too early at the time, but there's been such a big price dislocation there, and so to us, there's much more value in single Bs and triple Cs versus double Bs, for example. So I see value in triple C part of the market. I see value down in the capital structure, at least for now. If pricing changes, then we'll exit. But as of right now, we see value.
Do you share that view, Diana?
I think you still need to be fairly select, but in this backdrop where the Fed's balance sheet is still increasing, you have relatively easy monetary condition, there is money to be made in dipping a little bit further down the credit spectrum. I think for the first part of this year, it's not going to be a nuanced rally. Everything should be supported, barring a shock, a geopolitical shock, but everything should be supported by the external backdrop. I think where nuance counts is later on in the cycle, and I thought the S&P report was quite interesting because the things they're talking about are things markets have talked about for a long time. Autos sector, which has been the problem child, is something they're flagging as potentially one that could need to be adjusting more. Whereas we have seen a little bit of improvement in some of the other sectors like telcos. In the triple C part, it's the energy stocks that have really underperformed. So I think for us, it's more, you look at it on a sector by sector basis and you try and look for where there's improvement, or at least where the valuations compensate you for that risk.
You mentioned the auto sector. The credit team here at Bloomberg crunched some of the numbers that S&P did with the revisions to the credit ratings. 11-to-1 was the downgrade to upgrade ratio for 2019 in that sector alone, which is absolutely terrible. But to Greg's point, if you're going to start looking at the areas of the market that didn't do so well, that lagged in 2019, is that a sector, an area you'd be willing to look at? And if we get some kind of stabilisation in the economy, is a cyclical tailwind enough to offset what are very big structural issues in that particular area, that particular sector?
It's again on a very much on a name-by-name basis. I think the structural issues, so in the US, we're talking about market saturation. That's not going to go away. The sector may have gotten a boost from what the Fed did last year, so consumer credit becoming more accessible. But again, it's very much on a name-by-name basis. Some of the triple Bs, autos, are expected to be downgraded to high yield this year. Markets are already pricing that in to an extent, so there might be some value there where the bad news is in the price. In Europe, I think the balance sheets starting point is a little bit stronger there. Balance sheets are a bit stronger. Some of the names have been hit hard, such as Volkswagen, which was forced to actually get up to speed with the regulatory environment much sooner. Again, very much on a name-by-name basis rather than a sector-wide. I think long-term challenges for the sector will remain with us.
Quick final word, Andy, on the auto sector. Your thoughts?
I think, as Diana said, there's some fundamental problems that need to be addressed in terms of the change in that sector. It's similar to the energy sector, in my view. It's going through a whole fundamental change in how people buy cars, how people look at cars and the type of cars that they're buying. I think the challenge with Europe, Diana mentioned Europe, just looking more generically at European credit, excess returns of European credit last year were over 5% for an index that yields about 50 basis points. So I don't really understand how people can come into 2020 with a particularly bullish view on credit, given the returns we've enjoyed in 2019. I think autos, as Diana said again, it's going to be name by name, but at least in that area where there has been some underperformance, there's maybe the opportunity to pick some names that do deliver and do recognise the challenges that they're facing. But it's another sector in transition like energy.
Final word around the desk, Greg.
No, I think it's still time to be invested in credit. And so I think it's too early. It's name by name, it's dispersion, but I still think it's a place for alpha.